The first rates then on your screens, and it's a flat start for the Nifty, sub the 17,800 print. Let's talk about what could be the culprit, and I think it would be the IT pack. So let's see what TCS is up to. Firstly, it's a miss on revenue as well as margin. Order book though has managed to hold up well. The dollar revenue is higher by 1.7% on a sequential basis. TCS is down 1.5% as we speak. The Nifty IT index also dragging about 1.5%. What is Infi up to? What is KPIT Technologies? Infi is lower more than what TCS is. Tech Mahindra down about 1.7%. So it's largely 1.5% to 2% cut that you're seeing pretty much across the board. And that can be said about the mid-cap end of IT as well. Let's see now what AU Small Finance Bank is up to, because that should be seeing a positive start. That's gapped up 9.25% this morning after the MD and CEO extension 2-3 years, which got approved by the RBI. RBNL, once again, it's got a letter of award worth about 63 crore rupees from Northwestern Railways. There's ONGC and Oil India also, which are going to be temperamentally higher, perhaps, considering the crude gains. Crude, remember, like I just highlighted, Brent is back above the $87 per barrel mark, but that's not going to spell all that great news for what some of the paint companies are going to be doing, and considering how expanding this sector is with a new entrant, Pidilite as well, jumping into the fray, into the segment. Anand Rathi Wealth, their revenue has come in higher by 4%. They missed the AUM guidance as well by a solid 2,000 odd crore rupees, although the stock is still holding higher as we speak right now. Couple of other order wins for a RITES. It's got a 72 crore rupee order. There's SRF as well, which is in focus. Their pharma project has been commissioned and capitalized at Dahej. Lupin, USFD has classified 4 of 10 observation for their Pithampur unit as a repeat. So Lupin is down about 1.5% as we speak. But talking about Lupin, let's see what the rest of the pharma pack is up to, considering the buoyancy which came back into the entire space. Divi's, Laurus Labs, Metropolis, DRL, some of those stocks are sustaining their gains, although Divi's is not after that big move yesterday of about 9.5%. Right now, though, it started off lower by about 1% as we speak. But Kunal, a very sedate start for the Nifty, and we haven't managed to hold on to 17,800.
Yeah, so far, Aisha, I would still probably wait out for the second half. I think the market should get into a recovery phase, and even if we don't close above the 17,800 mark, that's absolutely fine, because we are bound to consolidate after 7-8 days of consistent price up move for the indices. Now, the opening stock, which I think looks attractive from a short-term trading play, would be Tata Motors. The stock, after a 2-day pause, prior to that, a 2-day of strong uptrend, looks very attractive in terms of risk reward. So I think at 465 looks attractive for a target of 500, would be bullish on Tata Motors.
A very interesting move in IndusInd Bank, and I wanted to flag out that because that opened with a cut of around 4%. Suddenly, it's recovered from the day's lowest point. IndusInd Bank is the stock that I'm talking about. Yesterday, Somit was highlighting how the shareholding pattern has now changed, and it's likely that it might result in a bit of outflows when it comes to the MSCI adjustment as well. So the FI investment headroom stands at 14.19%. The minimum FI headroom required for MSCI inclusion is 15%. So there was a possibility that the March 2023 shareholding rules out IndusInd Bank's inclusion in the MSCI. So that's the reason that stock was in focus yesterday. Today as well, it's seeing a cut of around 3%. So that's one stock that I wanted to highlight. But AU Small Finance Bank definitely is a big outperformer, 10% higher. And then FACT saw an up move of 20% yesterday, another 5% up move today. But Nooresh, what about you? What are you spotting on the charts this morning?
So, looking at a buy on Gail, the stock has opened up around 109 levels. Any dips in the day also at current levels also looks like a buy. The stock is close to an all-time high, so expecting it to do a follow-on move over the next few sessions.
Let's connect as well with Prateek Gupta, who's joining us on the show to give us a sense of his outlook on the markets as well as valuations and the earnings season. Prateek, thank you so much for taking time out and joining in. Let's just get an overall sense as to what you're looking at when it comes to the market landscape at the current juncture. Do you believe that as of now, the undertone of the market is remaining quite positive, but global headwinds, the overall valuation, as well as concerns of the macros, is putting a bit of a concern on the markets in terms of the undertone being a little bit cautious?
Hi, good morning. Yes, we are still not bullish on the market as yet, but honestly, we're also not as negative as we were, let's say, at the start of the year, uh, because we've been through a fairly substantially long period of time correction. India has been largely flat for almost a year or so. And over the last 6, 9 months, we've also underperformed markets like Hong Kong, China, which had underperformed earlier. So global flows are also slightly more positive on India given the time correction and valuations. And meanwhile, the earnings growth in India for the corporate earnings growth, they've actually held up reasonably well despite the ongoing consumer slowdown, despite the global issues, etc. So you're absolutely right. We see two major issues on the downside. One is the global slowdown and the uncertainty around, therefore, how the Fed would react, both on the inflation front as well as financial stability, given the recent regional banking crisis. And second is just domestic factors like monsoons. For now, the fear has sort of subsided given the IMD's forecast, but we won't really know until May, June. And also we need to watch out for the distribution and the timing of the monsoon as well. So it's not just the quantity, and that obviously still has an important bearing on certain sectors. But overall, the medium-term outlook on India remains very, very positive. And we are one of the few countries, EMs in the world, where political stability is there, and the corporate sector has deleveraged. Banks have cleaned up their act. They're well capitalized. So to that extent, we're quite well positioned for an upcycle, but just not as yet is our view. Therefore, this year, we think earnings will still be somewhat subdued. At Kotak, in our estimate, FY23 will end the year roughly at about 11% earnings growth for the Nifty. And in FY24, we will end up at 13.5%, 14% for the Nifty. And FY25, we will see a little bit of a pickup going up to almost 16%. So that's slightly below consensus, but our concerns are around the ongoing consumer slowdown, the global slowdown, some of the export-oriented sectors. You could see further cuts. We saw that with IT, for example. So those sort of concerns. And India is like you mentioned, valuations are still on the higher end. We're still at 19 times FY24 earnings as far as the Nifty is concerned, 17 times FY25. So it's become more reasonable compared to 3-6 months back, but we're still not cheap enough.
Sure. Pratik, can't help but talk about IT, considering we were just chatting with the TCS management, and while they still see a probability of a double-digit growth in FY24, they're only at best confident about UK. Say US is still pretty much nimble, and there are increased risk aversion and caution in the spend segment in the near term. Can IT really pull a rabbit out of the hat, and can it do the trick after, stark underperformance of late?
I think the most important thing to keep in mind is that this time around, the IT downturn, even if the US slows down quite sharply, which is not our base case, especially given what the markets are pricing in globally, we don't think the Indian IT companies this time around will be as badly impacted as we saw in, let's say, the 2008 crisis, or even going back 25 years to the 2000 post Y2K bubble bursting and the US tech spending slowdown, etc. While there is clearly the issues of the regional banking crisis, and there is a slowdown in some discretionary spending, decision making is taking longer, deals are taking longer to close, pricing, there's very little pricing power, if at all. But the benefits are also that attrition rates, wage hikes are coming off. And I think more importantly, this time our companies in India, they've gotten the scale, they have really beefed up their capabilities, the breadth of services they offer. And also don't forget, there's a cost takeout initiative going on right now in many of the US companies. So that's where, again, our Indian IT companies are relatively well positioned to help their US customers take out costs, as well as the ongoing stuff like cloud migration and apps for the cloud, and later on we'll soon have AI and machine learning also picking up the whole digital theme. So our companies are quite well positioned. So there will potentially be some more downside if the US downturn gets worse, but that's not a base case for the time being.
Okay, so that's not the base case for the time being as far as how the outlook for the IT sector and demand environment in across the globe is concerned as well. But then Prateek, where is it that you are seeing value when it comes to the various sectors? How is it poised? Is it the likes of autos, etc., which is likely to do well? Are you expecting a bounce back in consumption? Where do you see value the most?
So the only sector where we still see some value is still the financials. I know it's a consensus view now, I think, across the board, and the sector is reasonably heavily owned. But nonetheless, that's the only sector where valuations, even on a pre-COVID basis, are still somewhat reasonable compared to the rest of the market. They're still somewhat reasonable compared to the growth and ROE prospects. They're still somewhat reasonable. And given the likely pause in rate hikes, we think the RBI will stay on a longish pause. Globally, the markets are pricing in that the Fed will hike only 25 bips next month. And after that, again, there could be even rate cuts going forward. So banks, we think, are still looking quite good. Loan growth may slow down slightly, but hopefully not too much is our view, given we're not assuming a bad monsoon. We're not assuming a very sharp global slowdown. And also credit costs will likely continue to come off a little bit. Margins may come off slightly, but not too much, the NIMs. And therefore, banks still look good in the overall context. Even the NBFCs, given that perhaps the worst of the interest rate hike cycle has is over. So we like the private banks, even PSU banks, some of them, the larger ones, the NBFCs, more the auto-focused NBFCs rather than the consumer-focused NBFCs. Consumer sector generally either still expensive or we see more risk of earnings downgrades given the ongoing consumer slowdown, and there's no sign of any imminent recovery. This slowdown can carry on for a few more months or a few more quarters. Very tough to figure out when the recovery will happen. No signs of it as yet. So therefore, really banks and the financials. Second category, I would say, is some of the smaller sectors. There are pockets of value in real estate, for example, more residential real estate. Then there is hospitals, telecom in a few cases, and so on. So by and large, the market, like I said, is still not cheap enough. It's getting cheaper. It's become more reasonable. But are we cheap? No, not yet.
Interesting that you talked about real estate, Prateek, considering, the Q4 updates from most of these companies and, pan-India presence players has been very, very strong. But what I want to understand is that given that, when it comes to real estate, the problem is always the debt that they hold on their balance sheets. Would you stick with the larger players, the more cleaner balance sheets, or would you say have an across-the-board sector exposure because that's going to give you better returns?
No, I think you hit the nail on the head. That has been historically been the problem with the real estate companies, the high debt some of these companies used to carry in the past, especially even the larger ones. But there's been a dramatic change in the last 5-7 years where most of these companies have significantly deleveraged and they're generating good free cash flow in some cases. So I would say rather than the size of the company, large versus small, one has to look individual company-wise and look at companies where the debt levels are now under control, because there is, like I said, there is still the risk that we may see a bit of a slowdown both domestically and globally, which may be worse than expected, in which case you don't want to be stuck with a real estate company, which is a very high leverage and could really face a pretty bad time. So therefore, still stick with the companies where the balance sheet outlook is balance sheet quality is very good, and there are honestly both large caps as well as some small and mid caps which are niche city centric players like in Bangalore, etc., which are quite decent and where the sales growth is still going on quite well, and at least over there in real estate, we've not seen any meaningful signs of any kind of slowdown even in the month of April so far.
Prateek, it was quite interesting that we've seen the likes of an L&T quoting at its 52-week high, the fact that order momentum has been intact, and that really, spells a lot in terms of what the underlying economic strength as well is. Do you believe that there's a lot of potential to really build on this theme, the likes of defense, railway, capital goods as a sector?
I think it depends on your time horizon. If you have more than a 1 year time frame, a 2, 3, 4, 5 year time frame, yes, absolutely. These are, in our view, very strong structural growth stories. The private capex cycle in India has been depressed for a very long time. We are seeing the government, both the central government, state government, as well as even PSUs stepping up and keeping up the capex momentum on their side. And we obviously have the elections coming up next year. So generally, we tend to see pre-election spending by various state governments and even the national government. So the outlook is very strong. And also, as I said, the private capex cycle, while it's been delayed and we keep waiting, but it's with every passing quarter, we're getting closer and closer to when it sort of takes off. So that's where these companies, while in the short term, meaning the next few quarters, there is still the risk of a modest disappointment in earnings or order inflows or perhaps margins. But structurally, these are very, very high quality opportunities to play the India domestic growth story. And the only caveat I would put is companies, the cap good companies, which have a very large proportion of dependence or revenues coming from exports, either to Europe or to the US, either to the parents or parent organizations or other customers globally. That's where we are seeing, given our sort of cautious view on what's going on globally, the preference would be for those companies which are somewhat more domestic oriented. And L&T obviously is one of them, although they have the Middle East exposure, but that again, with oil staying quite high, that helps them as well. But structurally, we are very positive. It's just short term, we would be sort of more neutralish. We don't expect a very big correction as well, given although there is a very high, most of these stocks are no longer cheap. But at the same time, given the structural growth prospects in our conversations with many investors who have a long-term view, everybody is waiting for a correction to buy these stocks.
Prateek, what's the house view on how to approach pharma?
So pharma, we are sort of neutralish. It's very, very stock specific. I think one general comment we'd make is in the pharma sector, it's very, very company specific. You've got the APIs, the generics, the domestic kind of companies, the more export-oriented companies, and then large caps, mid caps, small caps, etc. We've seen a series of generally disappointments across the board, either governance issues or some US FDA issues, or delays in ramp up of certain products or getting approvals and so on. So the general pharma space, we would be somewhat cautious. There are a few niche companies, or not niche, specialty pharma companies where we would be more positive. But our general preference would be, but let me just say, sorry, we are not negative on pharma. We just sort of neutralish, very stock specific bottom-up views. However, our general preference would be to go for healthcare, and within healthcare, more hospitals, not diagnostics. Diagnostics, we still think competitive intensity is still very, very high. There could be risks of further revenue and margin disappointments. But hospitals in general, we think the outlook is very strong. The stocks have corrected quite a bit. Valuations are getting more reasonable, and these companies are generating reasonably strong growth, and the ROEs are quite good. And there are both large caps as well as certain mid cap hospital companies, regional players, or special niche focused hospital companies which are on, let's say, children's care or something. Those kind of companies, they still look very good to us.
Thank you so much for taking time out and joining in, giving us a take as to what your outlook is on the market. Time to shift gears then, and let's put the spotlight then on the fertilizer space, talk about the declining prices, what the road ahead is in terms of rates as well as sector trends. We've got Kishore Rungta. He's the Chairman Managing Director at FACT, now joining us on the show. Thank you so much for taking time out. Let's begin by just talking about what the demand is looking like for the Kharif season. Is there an expectation for low demand for fertilizers, largely due to the kind of predictions that we've been getting from the Met, that there could be marginally lower than normal rainfall due to the El Nino impact? And how could this impact volumes, according to you?
Yes. Good morning, ma'am. First of all, thank you very much for giving opportunity. But let me tell you that we are very much optimistic with respect to the demand for the Kharif. And even though there is a prediction that there will be a little shortfall in the rain, but we are anticipating that the demand, what was there in 2022, will continue in 2023 also, because we are not finding any difficulty for selling our products in the market.
So if that's the case, your fertilizer production in the year gone by was around 1.07 million metric ton. What kind of expectations are you penciling in for FY24 with respect to volume growth and production?
No, the volume will remain more or less same because the last year also, if you see all the companies more or less they have produced their 100% capacity. And in fact, there was some pressure on import because the prices were going high. But this year, luckily the prices are coming down. So the ample number of fertilizers are available in the market with respect to DAP, MOP and NPK. So we are not finding any difficulty as far as the supply is concerned.
Happens to your margins, and will you be passing on the benefits of low costs and bring down the prices too?
We have already passed on, in fact.
Okay.
In fact, we have already passed on more than 3,000 rupees per metric ton. We have passed on to the farmers last month only. So definitely when the prices are falling down, we are supposed to pass on the benefit to the farmers. As per the government norms, we cannot keep the margin more than 12%. So all the companies, in fact, they are passing on the benefit to the farmers.
Just to understand, you said volumes will remain flat year on year, plus the prices are coming down, margins are capped at 12%. All does that mean that profitability will actually be lower in FY24 versus FY23?
No, madam, see, when the prices fluctuates, when the price goes up, if you see the last year when the prices have stood up by more than 300 and 400% in some of the products, the government has given the subsidy and they have increased from 1.05 lakhs crore to 2.25 lakhs crore. So that is how the market is getting stabilized. Otherwise, we would have increased the price like anything. But we are not allowed to increase the price because the government gave the subsidy. Now, when the prices are coming down, there is a possibility that the subsidy will come down from 2.25 lakhs to some lower level.
Okay,
So it is a subsidy which will balance the things.
Okay, so the subsidy is something that, of course, balances the things out. But what about the raw material price levels? Are they stabilizing at this point of time? Given last year was very challenging with respect to the global volatility, have the raw material prices substantially moderated now?
Very much at a downtrend. All the prices of the raw materials are falling down on month-to-month basis. And definitely, and I hope the price has come to a level where now it will stabilize.
Okay, so that's the view coming in on the raw material prices. And given that the government is now mulling announcing new rates for NPK fertilizers next month, is there any talks on what could potentially be the rate price, the rate and the price change?
No, government is working out because the government decides the subsidy based on the nutrient contents like NPKs. And since all the nutrient contents prices are going down, definitely government will see the average price for last 6 months and accordingly the subsidy will be recommended. I understand that the recommendation has gone from the ministry and it is waiting for the cabinet approval.
Right. Mr. Rungta, if it's possible for you to, give us a guidance, and if really could you spell out numbers as to what growth visibility do you have for the full fiscal, both in terms of realizations and what the margin range could be?
For you're talking as an industry as a whole or FSCT per se?
FSCT per se.
As far as FSCT is concerned, my volume will remain more or less same because I am running the plant with almost 130% capacity utilization. So I don't find any scope to increase further productions at the plant level. But of course, we have a very optimistic plan for the import of fertilizer. And definitely that will give me the 50% increase in the volume as far as my total sales will be concerned. Because last year I have sold almost 1 million ton. This year my projection is 1.5 million tons. So since the prices fertilizers are available in the international market, my company is expecting to import another 5 lakh metric tons fertilizer to be sold in this year. So the volume will go up by almost 40 to 50% this year.
Oh, so the volume is expected to go up by 40 to 50%, but that will be led by imports. Why not increase the capacity then? What's the plan with respect to the capex, at least, the greenfield or the brownfield expansions that you can take?
Yeah, very good question. We are going for the greenfield expansion. In fact, we are setting up another plant with 5 lakhs metric tons where we can produce different grades of fertilizers, including DAP. So that is still going on. I'm expecting by 24 and by 24 September, the plant will be commissioned. So that will give me another 5 lakhs metric tons of productions. That will be a very good basket for the FSC.
Also wanted to get a sense from you, India is now becoming a hub for manufacturing for a lot of things and fertilizers. You talked about the dependency on imports. Is there a case to be made that overall with the industry capacity coming up, imports can come down and manufacturing as a whole in India can ramp up substantially when it comes to fertilizer sector?
Yes, certainly. If you see the government strategy, government has already initiated to set up new 5 urea plant, and that will add another 60 lakhs metric tons to the production capacity of India. Apart from that, there are 2 private companies that are coming up. One is Matrix, another 12 lakh metric tons. If you see the total dependency on urea itself is 90 lakhs metric tons. So that will be totally wiped out. Apart from that, government is also trying to introduce nano urea. So whatever the little gap will be there, around 10 lakhs to 15 lakhs metric tons for the import of urea, that will be bridged by production of nano urea. So if you see the total import of the country, it is 200 lakhs metric ton. Out of this 200 lakhs metric tons, 100 lakh metric ton is only from urea. And the MOP anyway, the country do not have the MOP. So that's what we import, around 40 to 50 lakhs metric tons. That anyway will be importing, because that is a mining product which is not available in India. So that will be only imported. For rest of the things, government is taking adequate steps to stop import. In the next couple of years, the result will come out.
Interesting. Mr. Rungta, thank you so much for taking the time out and speaking with us this candidly to, help us give a better picture on what's happening with the overall fertilizer sector and, of course, FACT as well.
Thank you.
Okay, that's the word coming in from FACT. In the meantime, let's take quickly a look at where the market have settled in at, because we started off flat and we're still pretty much there. The good thing is that the index has managed to slowly creep up to that 17,800 mark. At least that's the print on the Nifty futures. 17,870 is where we're currently at. From the Nifty spot as well, we've reclaimed 17,008K as we speak right now. AU Small Finance Bank, that's the stunner performer today. There's been a big block deal as well. Besides, of course, the MD and CEO extension to 3 years, which the market has liked. It's 15% higher as we speak right now. And, there's India Marts for a second consecutive day, Apollo Hospitals, Escorts, Alcom, unusual list of movers out there. But let's try and understand what's really happening with the rural end of the economy, and who better than Lalit Agarwal from VMart as well to give us a slice of that. Lalit, hi, morning. Great to have you on ET Now once again. Lalit, help us understand, because the chatter is pretty grey when it comes to what's really happening in the tier 2 and tier 3 cities. You'll perhaps have a better handle on how, things are on ground and where you see demand going for your business.
Good morning. Definitely, India is coming up. We are seeing some betterment happening gradually every day, and that continues. Still, there are pains, and we don't know where the pain is coming from. But yeah, there are small pains which are still there. But largely, I think there is a lot of improvement coming in. The confidence of the feel-good factor is improving for the consumers in the smaller towns, especially even the self-employed people. For them as well, we are seeing their confidence level is going up. Their ability to spend still is not coming, but yeah, we should be getting it now. We are waiting for this Eid celebration also, because which is going to happen in this particular month, and which is going to also bring in some confidence index and understand how the confidence is going to be. So I think all of those will also give us more perspective. But yeah, largely it is inching up, it is bettering up, and still we would need another 1 or 2 quarters till the time it comes on the growth phase from that pre-COVID levels.
How niggling a worry is competition? Because, while demand, of course, is a factor on one end, there's also competition with many large format, chains which are now getting into value fashion. You've got Shopper Stop, you've got Zudio by Trent. Are you concerned about that?
Aisha, definitely there are good players coming in, and then I understand that good players are coming in for a good segment of the demographic where the India is flourishing, and that is where the large part of India's population is, and that's where the large part of India's consumption is. So what we have been yelling for a decade, and now people are understanding that there is an element of hope there. So there are players who are trying to come in, and that's a good news for the industry, and that's what we believe that gives us more motivation, that there are enough and more consumer also, and the aspiration level also, which is going to go up. It's all about all these competition or all these new stores which are getting opened. These are all welcomed, and these should all be welcomed by the society and by the consumers. And I think it is just an injection of consumerism and an injection of the GDP growth that we require, and largely at the mass level. And those K-graph economy is showing us the GDP growth, but it is largely coming in from the upper segment of the demography. But the lower segment of the demography needs to grow so that all of these gets benefited by and even the growth can get consumed. So I think yes, competition is coming up, and that's a good news. And there is a definitely competition both from the offline perspective as well as the online perspective. We have seen Meesho growing, we have seen Myntra growing, we have seen Flipkart growing, we have seen those the names that you said, Zudios, and then the other retail chains which have also been growing. So I think there is a lot of activity happening at this space, especially at the value segment, and that's a welcome move. And we believe the life is not going to be simple. It's always going to be tough, and it is always going to be challenging, and that's how it should be. And then that's how we should also get prepared, and that's all we are all doing to internally in the organization to try and look at the consumer in the different mindset and the different lenses, and how do we offer them better quality, better prices, and better product. So that's the overall mindset of at V-Mart that we have.
Okay, that's the take on competition. But what about raw material costs? How are they holding up? Are there any concerns of a sharp increase, and thereby could we see that impacting your margin picture?
No, I mean, the raw material prices definitely have come down from the peak, but still are higher by almost 40-45% than 2019-20 numbers. And so there is definitely a pressure on raw material which was there, which has come down, and relatively we have also understood that there has to be a lot of work that has to be done. And with all these schemes with the textile industries, a lot of new innovations and a lot of new machineries are also getting brought in, and through which there are a lot of innovation in fabric and a lot of blending of fabrics which are being done. So I think all of those blending and innovation are also bringing in some better product at a lesser price, and that is also helping us to provide the consumer with similar price points and the same price points without compromising on our profitability. So, but yes, there is definitely going to be a little pressure because we believe that our consumers are in pain and we need to deliver them at an apt cost and not at a higher cost. So we will definitely curb our margins and look our margins with their degree of caution, and then we will not go all out. But anyway, I think we'll definitely not play too much with our margin because we don't have too much to give out.
Okay, so the margin is something that you're going to probably narrow a tad bit to pass on at least some sort of benefits to the consumer given the price pressure and the demand being a bit soft. But what does this do to your expansion plans? Are you going a bit slow given the fact there is demand slowdown and there is more focus on capital conservation and profitability?
I mean, on that, we have always taken the view that India's story is a long-term story, and it is definitely going to grow in the longer term. We are hearing about this Amrit Kaal and this 2047 with 25 trillion economy, and I think or more than that. So I think what India holds is a lot of potential, and that's how we are right now banking on. So we are not compromising with our growth plan. We continue to open. We had opened up 59 stores in the last year, and we'll continue to open more than those number of stores in the current year as well.
Target, can you give us a number? What is the growth plan with respect to store addition and which geography specifically?
We'll be growing more than 65-70 stores in this particular year, and the geography should be pan-India because now we are present in pan-India with Unlimited in the southern India part. We'll grow that part as well because we are getting good traction and good benefits in a lot of small towns in southern India because there are a lot of virgin territories also in those particular area which we never grew. So that's an area we are focusing on. Apart from that, we will continue to focus on the northern belt as well as the eastern belt. The eastern belt is coming out very good. So the east and the northeast is another market that we are focusing highly on. Apart from UP and Bihar, which we continue to.
I want to come back to the demand scenario a tad bit because the kind of commentary that we are getting suggests that the apparel demand has been really low and the growth hasn't been as much, and even the wedding season has kicked off on a bit of a tempered note, and whether there were the early festivities of Gudi Parva etc. as well, they haven't really panned out. So can you talk to us about what the volume figures will look like perhaps in FY24?
I mean, see, definitely we are, when we plan our budgets, we do plan for growth and we are looking at growth, and we believe that there should be growth coming in. Definitely first quarter is going to be a little dull because of the first month of the first quarter has no weddings. In April, normally Indian calendar follows some Muhurat and stuff, and that auspicious days in April for a wedding is almost negligible, almost zero, and which is definitely giving us an impact in the month of April. But those weddings are definitely going to happen, and they are going to happen in the month of May and June. So we believe some demand should come back in the month of May and June. There is some loss that we will have, but this time we are seeing the festival of Eid coming a little before. Normally it gets pre by 10 days, and so this time it is around 22nd of April. So we will have a balanced view, but yeah, largely there will be a volume growth. We are expecting a volume growth from the last year, and there should be a good growth coming in, largely in the especially in the third quarter. The first quarter could be a little muted because of the first month of the year, which is a little bad. But otherwise, and then we also have an Adhik Maas in the month of July. So mind you, that is also another month where you can't have any auspicious days and any festival or even any marriages coming in.
Quarter one can see a decline on a year-on-year basis?
No, we are not expecting that.
Sure. Okay, on that note, we'll let you go. Thank you so much for joining us with that clarity. So a bit of a tepid and a muted note is what the management is projecting. But at least in the second half of the year, there is expected to be a bit of a pickup. So we'll watch out for that. In the meantime, the markets are holding on steady, 17,800. So there's not a big move happening. The range is very, very narrow for the day. It's been just around that 20 point. But individually speaking, there are a lot of movers in stock-specific action. So AU Small Finance Bank, we have been talking about it, locked in upper circuit of around 15%. Apollo Hospitals is seeing quite a bit of traction as well, 3% higher on that counter. Then you have UCO Bank, Alchem Labs, HDFC AMC. Some of these counters are also seeing quite a bit of buying action. On the losing side, we have LTI Mindtree, which is down 3%. There was a clarification that came on the news flow regarding some of the litigation pending in the US, but I read it to be a bit positive. I'll have to deep dive and see what the exact worry is with respect to LTI Mindtree. But the entire IT pack is actually on the back foot given the fact that commentary from TCS has been quite weak. So you have names like LTI Mindtree down 3%, Persistent, HCL Tech, Infosys and TCS all sitting with cuts of around 1.5 to 2%. But on that note, slipping into a very short break, don't go anywhere.
Thanks for staying on with us. It looks like it's a very tempered day of trade. So yes, we're holding on to the 17,800 mark, but it's confined to a range for now at least. And you've got some of those names that are managing to hold out in the green, but by and large, it is a pretty flattish day of trade. Let's just identify some of the nifty movers then on the upside. While IT is taking a back seat owing to TCS's tempered set of numbers, there's Apollo Hospitals on the flip side that's in the green, HUL, Nestle adding in a punch, SBI as well as Reliance Industries. Those are some of the other counters that are a buzz. And on the Nifty 500 as well, you've got names that are standing out, the likes of an AU Small, for instance, that we've been highlighting from the get-go. Graphite India is active in trade, HEG, Johnson Controls, and India Mart is up about 3.5%. But speaking of AU Small Finance, the RBI has approved the reappointment. This is of Sanjay Agarwal, who's the Managing Director and CEO of the bank. How is this really going to impact the stock? Why is it that we're seeing a double-digit gain? My colleague Vamakshi joins in to fill us in. Vamakshi?
Well, Sanjay Agarwal, the MD and CEO of AU Small Finance Bank, has received extension approval by RBI for 3 years, and this approval is in line with the 3-year extension that was sought by the bank. Now, remember, shareholders had already approved the reappointment till April 18th, 2026. Now, it is also important to understand what this actually means for the bank. The 3-year extension is the biggest positive that has come in for the counter, as the street was concerned about the same, given that the key man risk in the case of AU Small Finance Bank was very high. Morgan Stanley says that the stock could stop derating now, and in fact they're expecting some strong re-rating to come in over the next few years. It is also important to understand how the company has fared under his leadership. Now, since his appointment in April 2020, NIMs have improved from 4.8% to 6.2%. The CASA ratio has also significantly improved from 14% to nearly 38%. Loans and deposits have nearly doubled to 55,600 crores and 58,300 crores respectively. However, GNPA and NNPA has remained benign at 1.8% and 0.5%. ROA has improved marginally from 1.9% to 2%, but it is the ROE that has in fact seen a decline from 17.9% to 15.2%. But not just AU Small Finance Bank, there are several other banks that could be in focus on the back of their top PRAS terms ending in 2023. First up, we have City Union Bank. The term will be ending in April 2023. Equitas, SFB, Karur Vyasa Bank, HDFC Bank, ICICI Bank and Kotak Mahindra Bank are some of the banks where the top PRAS term ending will be in 2023.
That's AUSFP. There's also, of course, a block deal as well. The stock holding up very, very smartly. But Bank of America has come out with a brokerage note on India Mart as well and has upgraded the stock now to a buy. Lisa is here with more details on that.
Is in focus as Bothra has upgraded the stock to buy at a target price of 6,390 per share, which entails at around 15% from the current price. Well, there are two triggers for this upgrade. One is the steady momentum in business and another is the stable competition that the company is facing. Well, on the business, they say that the free cash flow generation that is expected to continue on the back of improving margin and steady growth in business. Well, they anticipate that the EBITDA CAGR over FY 23-26 that is expected to grow at around 28%. Well, secondly, on this competition, they anticipate that the unlisted startup space where they were facing competition owing to the low funding winter, the competition has declined in that space. Also, when we see that the diversified mix, the India Mart has a diversified mix and there is no dependence on a particular segment as such. Also, Bothra has noted that most of the B2B space is not facing any slowdown as it is facing in the B2C space. So, well, on the back of favorable risk reward in the current environment, Bothra is bullish on India Mart.
Okay, let's talk some of the other buzzing stocks. Kunal, let's take it across to him and find out what's the chart buster that he's been tracking. Kunal, Tata Motors, not surprised with this one.
Absolutely, Aisha. And yet again, I think the stock is showing some very classical patterns on the longer term time frame chart. So what I've pointed out for Tata Motors is more on the long term time scale. Over the last 2.5 or 3 years, the chart patterns have been very, very intriguing. The stock after a phase of rally has this odd tendency of going into a multi-week, multi-month consolidation depending on how strong the rally has been for Tata Motors. For example, from the 2020 lows, the stock formed a triangular consolidation where it remained in a range after a very strong rally. The moment the stock broke out, we saw a very strong up move coming back into the stock price. Then there was a similar consolidation at the fag end of 2020 where the stock again remained to a tight range, again a very similar kind of a breakout. Extrapolating this to 2021, the stock going into a range back again. For almost 7 to 8 months, and then once the breakout happened, the breakout, led the stock to change its behavior where the previous resistance became a support. And now we are at a point where the stock has ended into a 1 year of major consolidation, and it's now confirming a breakout closer to this 470 odd mark. So I believe Tata Motors is something to watch out for, not just from a shorter term perspective, but from a medium term perspective. And looking at the historical instances, there is a very strong indication that the stock may come back towards the all-time high levels, possibly in the next 1 to 2 years.
And Kunal, what are the other stock trades that you're recommending?
So two buy calls. The first one is a Aban Poonawalla FinCorp. That's a stock which looks attractive on the short-term charts, heading towards a breakout above the 290 mark. Suggesting a buy with 310 as a target, stop loss at 280. And the second would be a Aban DV Slab. Again, a stock which has recovered quite smartly on an intraday basis. Looks attractive for a target of 3,300, stop loss at 3144.
All right, that's the view coming in from Kunal, his top recommendations and charts. Moving on to an exclusive interaction then with Sugar Cosmetics founder and CEO Vinitha Singh. She talks about her entrepreneurial journey, Sugar's swift rise, and tells us if the sweet gains in terms of profitability and growth are in store ahead. Listen.
We do expect that next couple of years we should be quite close to filing a DRHP. The idea is, of course, FY24 we should be profitable and we should accomplish this 70% growth target that we have in our mind, which would also help us become the second largest brand in this category, in the color cosmetics category. We feel that going into that IPO stage where you have a shot at becoming the largest brand in the category, still the fastest growing profitably, with good fundamentals is I think the perfect timing. And of course the market does now value profitability a lot, so which we want to ensure that we get it out of the way over the next 12 months.
Okay. Let's move right on and talk about the penetration in terms of how many standalone stores you currently have and where you're present via other stores as well. What's the retail presence?
Sure. So we have stores like these of our own are about 180. Okay. And they're great places for us to bring influencers, bring the community, our customers in to learn. So almost 50% of our business actually now comes from tier 2 and tier 3 cities. where the consumer is beginning to become as aspirational. So in these cities, we have some of these stores where we're becoming like the first brand that went to that city and started a makeup store. And I feel that women in smaller cities are as aspirational. They're spending as much time on social media. It's just that they still don't have access to the best products in the world.
Right. Yeah, and you have makeup artists there. Maybe I should have got my makeup done over here as well.
Yeah, next time please give us the opportunity.
100%. But you were talking about that tier 2 and 3 penetration, nearly 50% of the business. Is that what you plan to really leverage and grow, looking at those tier 2 and 3 cities vis-a-vis the metros?
So tier 2, tier 3 will, of course, because that's where a bulk of India resides. For us, metros also continues to grow, and we do feel that probably by the end of next year, we'll be at more like a 60-40 split between tier 2, tier 3 and metros and tier 1 cities. The good thing about the internet is that e-commerce lets you deliver to 90,000 pin codes. So I don't think that in terms of strategy for an omni-channel brand like us, you don't really need to carve out a separate strategy, because wherever in 19,000 pin codes, you can deliver the next day or the next to next day. So anything that launches at sugar, in the house of sugar, is actually available in a Tinsukia in Assam, within a couple of days as well. So I feel that that really democratizes this whole tiering. And we don't need to look at these strategies differently anymore, because it's the same consumer in different parts of the country. Maybe there are some changes in terms of the language, so which is why we have a lot of vernacular content now. Maybe you need local influencers, you need makeup to get localized, the content to get localized. And those are the changes our team is working on. But overall, from a product strategy perspective, I think we look at all of the tiers as the same.
Okay. And just looking at the inflationary pressures as well, one can't deny that you felt it. Has there been any increase in prices on SKUs? How have you dealt with the inflationary concerns?
So for us, because this is a category which operates at a 70% gross margin, we don't really we don't really pass through the inflationary pressure to the consumer. But as a brand, over the last 6-7 years, we didn't revise our prices. So there are some SKUs where we've revised the prices over the last 12 months. But in majority, 80% of our SKUs, we've absorbed the entire impact of inflation and not passed it to the consumer. I feel that for us, there isn't as much impact of this pressure on our supply chain from a costing perspective. But of course, what I'm wary about is that finally inflation impacts demand. And if the demand, which has been the last 3 months have been fabulous for us. Jan, Feb, March, were our biggest month in terms of tertiary sales, in terms of net revenue. All metrics have been out of the park. On a year-on-year level, we were at double the revenue of last year. So all those indications are good. But of course, April, May, June for us is the beginning of what we call off-season. And that's why we have our fingers crossed. And I feel my biggest fear is that if some of this inflationary pressure results in demand slowing down, then that is impact that a young, fast-growing brand can't afford.
Okay. So what's the projection for your revenue, given that you said that there's been that phenomenal year-on-year growth? What's the projection for the next year, the year ahead?
So we're projecting about 70% growth in the coming year, and the year after that would be more around 50 to 60%. We still feel that we have a lot of market share to gain. The market itself
What's your
also.
Current market share?
Our current market share is about 6%.
Okay.
Yeah.
And you were talking about as well, leveraging technology, being very digitally prevalent. I understand that you can now use AI to check out how a color of lipstick will look. So how are you leveraging technology?
Yeah. So definitely, like you said, AR, which is allows you to figure out how makeup will look on you before you buy, is one of those important rollouts for us. Apart from that, I think one of the big things that we are seeing is that because we have access, thanks to the fact that in 2,500 stores we have our own makeup artist who has an app where every day she's recording every transaction with every consumer. This allows us a read of the consumer far better than any other brand. So at one level, our own app and our own stores, which is our direct-to-consumer business, D2C as you call it, makes that about 30% of our revenue. At the other end, even outside in shops and shops, we have our own makeup artists punching in data of what the consumer is shopping. This allows us for about 70-80% of our transactions, real-time knowledge of what is being sold in which pin code to what kind of a consumer.
Okay.
And that, I think, helps us in terms of new product development, in terms of merchandising, in terms of inventory optimization. It helps us with data which a lot of traditional brands don't have access to as on date. And I feel that the biggest work that is happening in terms of AI at Sugar is really using this data to make decisions on what is getting launched, what is getting rolled out in which city, what is showing up in the catalog in which store, how the trend is going to change for the wedding season versus Karwa Chauth versus Durga Puja. All of that is, insight is coming from this data that we're sitting on and that we're continuing to analyze. And I think AI is doing earlier, it was all on Excel sheets that you were figuring out merchandising in store, but AI is making it much easier to do this in a more scientific way.